I'm going to provide some hints on exercise 335 and analysis of cost structure. So it provides information on two separate companies, and I'm just going to focus on one of them to keep the video pretty short, and that's Winter's Company. So I'm going to skip ahead a couple sentences. Winter's Company is dominated by fixed costs. So it's saying it has a higher proportion of fixed compared to variable costs. So they're going to have a very high contribution margin ratio, and that here is 0.7 or 70%, and their fixed costs are going to be 310,000. Both companies, including Winters, have sales dollars of 500,000. The first thing that I'm asked to do is simply just list a very consolidated income statement and also state each dollar amount as a percentage of sales. So let's start out and just list, what do I know? I know sales is 500,000. Well, sales as a percentage of sales is 100,000. So that's a pretty easy starting point. Fixed cost, they told me, for Winter's Company is 310,000. Where I got the 62% is I took that 310,000 in fixed costs divided by the sales of 500,000. So therefore, fixed costs are expected to be 62% of sales. What else do I know? I'm told that the contribution margin ratio is 0.70. That's 70%, so I can list that. Well, sales minus variable costs gives us contribution margin. So therefore, sales ratio minus variable expense ratio gives us the contribution margin. So if I know that the contribution margin is 70% and that has to total up to 100% to get back to sales, therefore the variable expense ratio must be 30%. Now that I know the percentages, just take those times the sales dollars. For example, 500,000 in sales times 30% variable cost ratio equal 150,000 in variable expense. $500,000 in sales times 70% contribution margin ratio equals 350,000 in contribution. So I've got most of this filled out. Pretty easy fill out for the end. Operating profit would be the contribution margin dollars of 350,000 minus fixed cost of 310,000 equals operating profit of 400,000. That 8% can be found two different ways. One way is taking the operating profit, 40,000, divided by the sales of 500,000. So profit is 8% of sales. Another way is taking the contribution margin ratio of 70% minus the fixed cost ratio of 62%. Again, gives us operating profit of 8%. Now, the next point of this is B, and it asks us, what is the new profit going to be if sales increase by 8%? So I can go through and restate this whole entire income statement. And since it's abbreviated, it would go pretty quickly. Some things to keep in mind is sales is going to increase by 8%. Variable costs are going to increase by 8%, and contribution margin is going to increase by 8%, but fixed costs will stay the same. Now, it does take a little time to restate this income statement, so I'm going to provide a couple additional ways to do it that may be a little bit quicker, and so these types of things can be helpful on exams. One way is to take the dollar increase in sales and multiply it times the contribution margin ratio. So here, original sales was 500,000 times an 8% increase. That's a $40,000 increase in sales. Multiplied times the contribution margin ratio of 70% gives us that we predict profit will increase by 28,000. If you restate the whole entire income statement, it does work out. You may look at this and say, how does this work out? Keep in mind, fixed costs do not change. The only thing changing are sales, variable costs, and contribution margin, and they're all increasing at the same rate, 8%. That's the rules of them. So my $40,000 increase in sales, again, 500,000 times 8%, 30% of it is going to go to cover the additional variable cost. 70% of it is going to be extra contribution margin. And since fixed costs don't change, it's also going to be the additional profit. That's one quick way to do it. Another quick way to do it is use the power of the degree of operating leverage. So if you recall from the chapter, degree of operating leverage is contribution margin. So here that would be 350,000 divided by operating profit, and here that's 40,000, and that gives us a factor. So that's 8.75. And again, you may say, well, that's not 28,000. So give me a minute. We'll work towards it. The degree of operating leverage gives you an idea of how many times that a percentage increase in sales is going to affect profitability. So for example, we already said we predict sales is going to increase by 8%. If we multiply that times the degree of operating leverage, here that's 8.75, we get the predicted increase in operating profit is going to be 70%. So you may look at this and go, I question that. A small 8% increase in sales is really going to increase profitability by 70%. But keep in mind, this company is dominated by fixed costs, and those don't change at all when our sales change. So a very small change in sales can have a huge impact on profitability. If I want to prove out my $28,000 increase, I can take the original profit of $40,000. Keep in mind, that's a coincidence that also agrees with the sales increase, but the original profit of 40% times the 70% increase in profit. And again, I work out the fact that profit is going to increase by $28,000. So hopefully these two shortcuts will help save you some time.